Hi, and welcome to another presentation from your business tutor, learning your way, anytime, anywhere. Standing still isn't an option for large multinational organisations. If they want to maintain and enhance their position in the world, they need to grow in size. So with that in mind, let's turn to look at the two main ways in which a business can grow externally, by a merger and a takeover. So what are we going to learn in today's presentation? Well, first of all, we're going to find out what a merger is. After that, we're going to look into what a takeover is, and finally, we're going to explore what asset stripping is. We already know from the first part in this series of presentations that external growth is when an organisation grows in size by joining up with another business. Now, although this definition is important, it doesn't tell us that this growth is achieved in one of two ways, either through a merger or a takeover. So with that in mind, let's ask, what is a merger? A merger occurs when two businesses agree to join together on equal terms and share control of the new larger business. When this happens, the existing shareholders from both companies are given new shares in the newly merged company, and the directors from both companies will make up the management team of the new company. As can be seen, this type of external growth is done on friendly terms and is agreed by both sides. So let's now move on and ask our second question, which is, what is a takeover? A takeover occurs when one company purchases another and takes complete control over the enlarged business. Now, as you might expect, there are two ways in which a takeover could occur. First, if the business being purchased agrees to be bought, then the takeover is referred to as a friendly takeover. If, however, the directors of the business being bought do not want to be purchased, then this would be called a hostile takeover. In such an instance, the directors of the target company will try to convince their shareholders not to sell their shares to the business that wants to purchase them. However, if they fail to convince them, and the shareholders decide to accept the takeover offer, then the target business will be purchased, even if the directors don't want it to happen. Based on what we've looked at so far, it would be fair to say that whether a merger or takeover occurs, the aim is to create a stronger, enlarged business. However, as is so often the case, there is usually an exception to the rule. And that is what we'll be looking at next by asking, what is asset stripping? Asset stripping occurs when an organisation takes over another business, not because it sees it as a good fit with its own, but because the assets owned by the business, such as premises, equipment and vehicles, are worth more than the business itself. Put simply, the aim of the purchase is not to promote growth in the enlarged business, but rather to sell off the assets of the purchased business for more than was paid to buy them. In other words, if the business was purchased for £1 million, the aim would be to sell its assets for £1.5 million, resulting in a quick £500,000 profit. After which the purchased business would either be closed down or sold on with lots of debt. As you would expect, asset stripping is not seen in a particularly positive light, as its aim is not the promotion of growth, but the making of a quick profit at the expense of another business. So what did we learn in today's presentation? Well, first of all, we found out what a merger was. After that, we discovered what a takeover is, and then finally we went on to explore what asset stripping is. As has been shown, all external growth occurs in two main ways, either through a merger or a takeover. However, the way in which a merger or a takeover takes place is very much dependent upon the specific method of growth used, which we will now go on to look at in the following presentations.